Morning, everyone. Economic Ninja here. I hope you're doing well. We're going to talk about banking news. There's a lot of banking news to cover. We're going to be covering everything from a bank in UK, Metro Bank, having to firm up its bank with shareholders raise more money. And we know that Europe is a basket case when it comes to its banking sector, just like the America is. But I'm looking for the European Union to collapse prior to America's collapse. We're going to be talking about a top Fed official or the top bank cop, if you will, talking about sweeping reforms for the banking industry in America and its implications on the banks. We're going to talk about third Flagstar Bank data breaches, the third since 2021. And then we're going to be talking about JP Morgan Chase, Bank of America, and gosh, I want to say it's Goldman Sachs hit with a massive fine. And when you find out why, it'll blow your mind. Okay, so let's start with Metro Bank. And let's see, we're going to record the time. I'm going to go ahead and put a table of contents down below for you. So here we go. Metro Bank, a troubled UK lender, raises money to shore up finances. Days after talks, the bank said it had raised extra money from shareholders and bondholders and would refinance a big chunk of debt. Now, remember, every time a bank has to um, uh, raise money from shareholders and bondholders, it dilutes the value of that bank stock. Every time bank stocks go down in value, it's harder for them to raise money because their valuations go to total crap. Type one, if you think that our banking system is on the verge of absolute collapse. Type two, if you don't, I'm just curious what you think. But going into this a little deeper, Metro Bank, an upstart British lender, said on Sunday that it has raised 325 million pounds or $395 million in new capital to help ease regulators' worries about its financial health. And that's what we're going to be talking about next. US regulators that are very concerned with the US banking system. Okay, so we have both Europe, UK, and we have American regulators finding very serious. They have a lot of issues with the banks right now. Okay, and that should concern all of us. The deal put together after days of negotiation is meant to help stabilize what is one of the first of Britain's so-called challenger banks, founded in 2010 by an American banking veteran, Vernon Hill, to take on incumbents like HSBC and Barclays. Metro was the first new mainstream bank in Britain in over a century. The bank focused on building physical branches in prominent locations, offered Sunday hours, and grew to 2.8 million customers and 22 billion worth of assets. But it has struggled after it disclosed an accounting error in 2019 in which it underestimated how much capital it needed to back its mortgages. We we are living in the latest and greatest mortgage collapse in modern history. The first one we had was MBS, and this one is now commercial mortgage-backed securities, which are going to take down mortgage-backed securities. This is going to be so exciting. It that led to regulatory fines and executive departures, troubles that it had never really recovered from. Its headache compounded last month after banking regulators rejected its year-long effort to use its own internal calculations to determine the necessary capital reserves for its mortgages. Shares in the bank have fallen as much as 60% since then. Let me stop and say, remember, banks had these great intentions in the beginning. They're building up, and they never thought that so many people would stop paying their mortgages. But how many banks figured on COVID, right? How many banks figured on the world shutting down? How many banks figured that governments were going to say, "Oh no, you're forced to stay at home. You can't go to work. You know what? You don't have to pay your mortgage." And all of a sudden, a lot of these banks got caught. And like as in what's going on with the Fed and over 700 banks that are in serious trouble that went to them last September, the September before this one, they're in trouble. And we have ourselves quite a massive collapse on our hands. It says here, it also includes the refinancing of 600 million pounds worth of debt in which the bank will write down the value of some of its bonds by about 40% and extend their maturities. Again, we're seeing massive losses in bond portfolios in banks. And it said here, and this is a great quote. Today's announcement marks a new chapter for Metro Bank. This is Daniel Fulmolkin, Metro Chief's executive, said in a statement. Isn't that nice? That means your bank's going under. All right, let's move on to the next one. And this story comes out of Yahoo Finance. It's entitled "U.S. Fed's Top Bank Cop Stops to Discuss Sweeping." U.S. Fed's top bank cop to discuss sweeping capital rules. He wants to implement new rules that are going to take the banks and put them into a stranglehold. Says the U.S. Federal Reserve's top regulatory official will discuss a sweeping proposal to overhaul bank capital rules before the country's largest bank lobby on Monday, as he faces intense industry pushback against the rules, which bankers say will hurt lending. Now, if you remember, um, we are looking we have done stories about Bank of America, where Brian Moynihan, the CEO and president of Bank of America, was freaking out when the Federal Reserve said, "Hey, to stay in line with Basel III requirements, we're going to require you to hold on to a little bit more capital." It equaled to around 3%. Brian Moynihan freaked out. Him and other bank CEOs said, like Jamie Dimon, JP Morgan, said that if the Fed makes them hold back that much, or in my opinion, that little bit amount of money, they will not be able to compete with other banks around the world. That shows you how fragile this entire banking system is. Now it says here the vice chair for supervision, Michael Barr's speech at an American Bankers Association conference will mark his first on bank regulation since the central bank in July unveiled the complex Basel Endgame proposal overhauling how banks gauge the amount of capital they must hold against potential losses. Now, let me stop and explain something that was landmark in Basel III, the end game, if you will. They made Basel III requirements changed gold to a tier one asset. Now, before that, cash and T-bills were considered tier one assets. But you look at what's going on in the treasury markets right now; they're absolutely imploding. We have not seen a bloodbath like this in recent history. We're talking well over a couple hundred years. This is really, really bad. And so, how many banks are now looking at it and going, all right, T bills are tier one asset, gold is tier one asset. Banks in America are going to start buying gold. I know it sounds crazy, but think about this. Costco just started selling gold, right? That's mainstream. And there are so many people that look at Costco as the gold standard for shopping, right? For prices, for value, and all that kind of stuff. Do you know how many people are now turning their head and to gold that never thought about buying gold before? And they're sitting there going, okay, wait a minute. Costco's selling it, and the headlines are all over the place. CNBC, mainstream media, and they're selling out, right? Of gold. You have people at the bank that run these banks. I know it sounds crazy, as simple as it sounds. They shop at Costco. And they're going, wait a minute, hold on now. I know we're not used to buying gold, but you know what? T-bills are losing value almost every day because the 10 years we've lost control of that. The Fed has to keep raising rates. The Fed said they're going to keep rates higher, which means we're afraid to buy T-bills. We're afraid to, because if we buy them today, what's to say that the value doesn't go down tomorrow because the Fed raises rates again, right? So how many banks are about to start pushing into gold? We know that other countries around the world or governments are buying gold, but now you're going to have this problem with banks. Okay, so let's dive back in a little bit more. Now, this top bank regulator, and we've got lots of bank news coming up in a second, but he says the proposal implements international capital standards agreed by the Basel Committee on Banking Supervision in the aftermath of the 2007-2009 financial crisis. Since July, banks have been pushing back hard, enlisting allies in Congress and ad campaigns. They say it will hurt mortgage borrowers, lending to green projects, and the broader economy. Those are all lies, just so you know. Those are all straight up lies. Type 3 if you agree that the banks are full of lies and they will tell Congress and you anything to keep the truth from you. I really truly believe that. Type 4 if you think the banks are honest and they just want you to live long and prosper. Now, Barr said he will be answering questions after his speech. An ABA spokesperson said in the group appreciates Barr participating, but he will hear our concerns about the very real economic harm these proposals will have on the economy and on customers and community banks. So the point is that he's going to bring in all of these new capital reforms that he wants to, that the banks are freaking out about. All right, so next, let's do this. We're going to talk about the next story, and this is a data breach, and it's very important we talk about this. It's called Third Flagstar Bank. Uh, I've never heard of this bank. Type, 5 if you've heard of this bank. Third Flagstar Bank data breach just had sorry, third Flagstar Bank data breach. It's Flagstar Bank since 2021 affects 800,000 consumers. Now this is what really scares me. It's one thing to have a data breach and you get hacked, but then to go so nuts to where you are so screwed up with your security protocols on your websites and your back end banking system to where hackers can break in 3 times in the last 3 years. That is staggering. It says here Flagstar Bank is warning that over 800,000 US customers had their personal information stolen by cybercriminals due to a breach at a third party service provider. Flagstar, now owned by the New York Community Bank, is a Michigan based financial services provider. Before its acquisition last year, was one of the largest banks in the United States, having total assets over $31 billion. So this is not a small bank by any stretch of the imagination. A data breach notification sent to impacted customers explains that Flagstar was indirectly impacted by Fiserv, a vendor it uses for payment processing and mobile banking services. Fiserv was breached in the widespread CLOP Move It transfer data theft attacks that have impacted over 64 million people and 2,000 organizations worldwide, according to a report by Emisoft. The attackers exploited a zero-day vulnerability in the Move It transfer product of Access Fiserv's systems, and from there stole Flagstar customer data the vendor held to provide services. Now, this is the third breach in 2 years um, for Flagstar since March of 2021, when it disclosed it suffered a breach from the Clop ransomware gang, who at the time hacked its Alcyon file transfer server in January. If you bank at Flagstar, I'm sorry. I don't know what to say. I can't imagine people keeping their money in this bank after the third attack. Now, let's do this. Let's dive in to this final story, and I think it's really important. It's about JP Morgan, Bank of America, and Goldman Sachs. They were just hit with a $53 million fine. Check this out. This is why. For failing to properly report millions of derivatives transactions. Now, this, I believe, is very serious, very important. This is why. We all know that banks do illegal activities, and what happens is they pay the fine, and the fine is pennies on the dollar compared to what they make doing that illegal or illicit activity. All right. What people need to understand is the whole failing to report derivatives is very serious because there's a shadow derivative market. And to explain a derivative, let me explain it. It's essentially an insurance policy on insurance policy on insurance policy. Let me give you a little bit better of a description. Let's say a bank wants to offer a new product, an investment product, and let's say that it is a fund that gives you exposure to the Dow, all right? And it says, you know what, we're going to give you exposure to the Dow, and we don't need to have in the fine print any stocks from the Dow. What we're going to do is we're going to start this fund, and it's at X, and say the value of the Dow is here, and you put money into it, and as the Dow goes up, if you pull money out, then here you go, here's your money, and so that's great. But then if it goes down and you cash out lower, well then we only give you a little bit of money, right? And the banks are trying to bet that you're going to lose money and you're going to cash out lower than higher, right? So it's essentially a casino. So what they do is they go and pull an insurance policy on that. They go, hey, we have X amount of customers, we have X amount, of funds in our bank, so we need to pull an insurance policy. And in the rare case that a lot of people, when the Dow explodes in price, and they all want to cash out, and we don't got the money to do it. And then they pull an insurance policy on that insurance policy just in case, right? And cover their bet. So that's essentially a derivative. Um, type type 6 if I did a good job of explaining a derivative, type 7 if I did a horrible job. But my point being is that when they don't report these derivatives, it does not give financial educators, uh, uh, financial, uh, people in the news, reporters, or industry experts a really good idea of how big that market is, right? And how vulnerable we are to an attack. That's what happened with mortgage-backed securities. There were so many shadow mortgage-backed securities that were not being reported, um, especially to very risky lenders, that we found ourselves in a massive collapse by 2008 because of that lack of transparency. All right. So that's exactly what this story is. And that's why I think this is very, very important that we go over. Says three of America's biggest banks are getting hit by the Commodity Futures Trading Commission, or the CFTC, for failing to properly report millions of transactions in the swaps market. JP Morgan Chase, Bank of America, and Goldman Sachs have been ordered to pay 15 million, 8 million, and 30 million in fines, respectively. According to the CFTC, Goldman Sachs was fined for unprecedented, quote unquote, failures regarding swap data reporting and disclosures of pre trade mid market marks. Let me stop there real quick and say, wouldn't it be nice if we had a system where we could get this kind of banking information out to the masses, where people go, well, wait a minute, what do you mean they paid a fine for doing illegal activities? And we don't like that. We're going to pull all of our money out of that bank. And it would crush the bank. It would just take them down in a second. But we live in a world where all the banks are equally breaking laws. That's how the system's set up. And they get a little slap on the wrist. And then they lead to a financial collapse, like what we saw in the great financial crisis, that led to millions of people losing their homes. Everything was taken from them. Sure, were they over leveraged? Yes, they were. But if the banks weren't doing all of this illicit activity and then causing, extra fees or calling bank notes, do all these, if you think about it, if that wasn't there, how much better would our economy be? A lot better, right? Also, we pay a lot less in insurance costs because the insurance industry gets hit like this. For heaven's sakes, look, AIG needed a bailout because AIG was going under because it was covering so many of these derivative insurance bets. Let's dive back in. Since the rule went into effect over 13 years ago, the CFTC says that Goldman has violated the regulations over 1 million times. Type 8 if that makes you sick to your stomach. But hey, Goldman's known as the smartest guys in the room. Why? Because they have infiltrated the government and other banking sectors, because they train their guys, they send them out to other jobs, and they always remain in that club. It says here, while Goldman has back reported more than 20 million swaps to date, the CFTC believes this figure significantly underestimates the true scope of the swap data reporting failures at Goldman. In addition, the order states on more than 1 million occasions since 2013, Goldman provided counterparties with PTMMS and that were inaccurate or failed to provide that data entirely. Now, CFTC goes on to say that JP Morgan failed to report data relevant to foreign exchange swaps. According to the press release, the bank didn't report more than 150,000 Forex spot transactions, and also incorrectly classified certain transactions, effectively leaving them unreported. Let me talk about incorrectly classifying certain transactions. One of the other problems we had in 2008 was that we were dealing with different tranches of debt that were classified different, either that be AAA rated, AA rated, triple B, double B, so on, right? And a lot of these banks, what they would do is they would salt the tops of these portfolios, knowing that most financial regulators wouldn't dive down, dig really deep down to look at the creditworthiness of these transactions. And up top, they would have, like, let's say AA or AAA. credit rated debt, and below is all into the B's, right? And so they were being priced at a better price. They were getting a better rate on their insurance for these derivatives. Okay. And that's essentially what's happening with JP Morgan. Now it says, as of for Bank of America, CFTC says the group failed to report or correctly report almost 4 million swap transactions to data repositories. They went on to say these reporting failures were caused by 25 types of errors that principally involve swap allocations, which are normally post-trade events where an agent allocates a portion of an executed swap to clients who are the actual counterparties to the original transaction. The order also finds that Bank of America did not provide adequate supervision from approximately 2015 to ensure they complied timely with their swap dealer data activity and reporting obligations pursuant to the CEA and CFTC regulations. Look, the fact of the matter is, these banks are getting slaps on the wrist. And we are watching the collapse, like the first story that I covered in the UK, of the European Union, the UK, and American banking systems. The entire West banking systems are failing right now, right before our eyes. World governments are buying gold. American banking systems are told that now gold is a tier one asset. I gotta be honest with you, I don't see a scenario personally, this isn't financial advice, where gold does not do well over the long term. If you're looking at the short term and trying to make a couple bucks on gold by flipping it, you're not thinking about the big picture. Wealthy people, they don't look at the day-to-day prices of gold when they're looking to store it for a store of value, especially in this day and age where we're hit with so many massive inflationary pressures. Look, I hope you got something out of this. Thank you so much for watching. Thank you to everybody who hit the thumbs up. The Economic Ninja is out.